let's see the first method of calculating depreciation amount. First, straight line method. So in straight line method, as the name itself suggests, it is fixed charge method. That is, a fixed amount of depreciation is charged per year over the year of the useful life of the asset. So year 1 some amount will be charged, the same amount will be charged in year 2, year 3, year 4 over the useful life of the asset, and the entire depreciable amount, that is cost minus residual value, will be depreciated, and at the end of the life or useful life of the asset, the balance will be only residual value. So cost, and then every year the depreciation is reduced, and at the end the balance will be whatever is the estimated residual value of the asset. So assumption in this is that the utility of the asset will be same over its useful life. That is the assumption in straight line method. So usually a rate of depreciation is given. So accordingly the depreciation is calculated on the rate of the depreciation is applied to the total cost, and the same amount is charged every year. Say if the rate of depreciation is not given, how to find the depreciation amount? The depreciation amount will be cost minus residual value, is also known as salvage value. So cost minus residual value of salvage value divided by useful life of asset. So let's take one example. Let's say the cost is 1,10,000 minus salvage value is 10,000, divide by useful life of the assets at 10 years. So your amount of the depreciation is 10,000 every year. Now let's calculate the rate. Rate of depreciation is your depreciation amount divided by cost. What is the cost? Cost is 1,10,000 into 100. That comes to 9.09%. So depreciation is charged at 9.09% of 1,10,000 every year till the period of 10 years. So at the end of 10 years, the amount will be fully depreciated and the balance in the asset account will be 10,000, which is the residual value or the salvage value. So this is the assumption in the case of straight line method, that the utility of the asset or usefulness of the asset will be same over the period of its life. Now let us see one example of straight line method. A firm purchased an asset for rupees 4,50,000 on 1st April 2014. Installation charges rupees 60,000. The estimated useful life is 5 years and the salvage value at the end of 5 years is rupees 10,000. So as per straight line method, financial year ends on 31st December every year. Calculate depreciation and written down value for 2014, 15 and 16. So we need to calculate what is the depreciation and written down value for the year 2014, 15 and 16, and the financial year ends on 31st December. That is 31st December 2014, 15 and 16. Now rate of depreciation is not given. Only we have been told that we have to calculate depreciation as per straight line method. So now let us first find out what is the cost of the asset. So working note 1, cost of the asset. So purchase price 4,50,000 plus installation charges 60,000. So the total cost of the asset is 5,10,000. Now this 5,10,000 needs to be allocated over the period of this 5,10,000, and there is one salvage value of 10,000. So this 5,10,000 minus 10,000 will give you the depreciable amount. This depreciable amount needs to be allocated over the period of its useful life, that is 5 years. Now let us calculate what is the depreciation amount. Cost of the asset, that is 5,10,000 minus salvage value or residual value 10,000 divided by 5, that is useful life of the asset. So that comes to 1 lakh. So amount of depreciation is 1 lakh per year. Now let us prepare one more working note and find out what is the depreciation and the written down value for 2014, 15 and 16. Working note 2. So cost on 1st April 2014 is equal to 5,10,000 less depreciation for year 2014. So depreciation for the year 2014, what is the depreciation amount that we have calculated? 1 lakh. Now this 1 lakh is for entire year, that is for 12 months. But here the asset was purchased in the month of April and the financial year ends on 31st December. So asset was used only for 9 months. So 1 lakh is for 12 years. So the depreciation for 9 months will be 1 lakh divided by 12 into 9, that comes to 75,000. So 5,10,000 minus 75,000 will give you 4,35,000. This 4,35,000 is known as return down value on 31st December 2014, or balance in the asset as on 31st December 2014. Then less depreciation for the year 2015. Now in 2015 the asset was used for the entire year. So depreciation amount will be 1 lakh. Now this return down value on 31st December 2015 is 4,35,000 minus 1 lakh, that comes to 3,35,000. Then depreciation for year 2016. Again in 2016 the asset was used for entire year, so it is 1 lakh, and the return down value is 3,35,000 minus 1 lakh, that comes to 2,35,000. This is WDV on 31st December 2016. So this is how we calculate depreciation on the fixed asset as per straight line method. Reducing balance method. Reducing balance method, also known as return down value method. So, here we assume that the utility of the asset goes on decreasing as and when it is used. So, when the asset is new, in the initial years, the utility will be more. Then, after some years, there will be some minor repairs and maintenance of the asset will also go up as and when the asset starts becoming old. So, the utility of the asset will go on decreasing over its useful life of the asset. Now, this is more realistic assumption as compared to the straight line method. So, usually what happens is whenever the asset is new, or for that matter whenever anything is new, then the repairs and maintenance for that particular fixed asset will be less in the initial years, but as and when we use it after some years, the repairs and maintenance will go up. So in reducing balance method, this is the assumption that the uh, asset utility will go on reducing as and when we use it. So, the depreciation is charged on the WDV instead of cost. So, in the year 1 it is charged on the cost. Then when you get a WDV, that is cost minus depreciation for the year 2, then the depreciation for the year 2 is charged on this WDV balance as at the end of the year 1, and then in year 3 depreciation is charged on the WDV at the end of the year 2 and so on. So the amount of the depreciation will go on decreasing as and when the years pass by and the asset is used. So now usually the rate of depreciation is given and that rate of depreciation is charged against that particular cost and then WDV in subsequent years to arrive at the amount of depreciation. Now say if the rate of depreciation is not given, there is one formula to calculate rate of depreciation for WDV, that is 1 minus nth root of residual value upon cost of asset into 100. So this is the formula for calculating rate of depreciation. That is, n is number of years of the asset. So nth root of residual value divided by cost of asset, and this entire thing we have to reduce it from 1 and then multiply it by 100 to get the rate of depreciation in case if rate of depreciation is not given. Usually the rate of depreciation is given and accordingly we have to apply that rate to the cost and in subsequent year to the written down value to arrive at the amount of depreciation. Now let's see one example for this. A firm purchased an asset for rupees 4,50,000 on 1st April 2014. Installation charges rupees 60,000. Depreciation to be charged at 10% per annum on reducing balance method. Financial year ends on 31st December every year. Calculate depreciation and return down value for the year 2014, 15 and 16. So we are given the rate of depreciation and the method of depreciation, that is as per reducing balance method. We need to calculate the depreciation and return down value for 2014, 15 and 16. Let's start. Working note. Cost of asset. How much is the cost of asset? 4,50,000 plus 60,000 installation charges. So that comes to 5,10,000. Then less depreciation for year 2014. Now this depreciation is on the written down value. Since it is the first year, the depreciation will be on the cost. So 5,10,000 into what is the rate of depreciation? 10% per annum. So 10 divided by 100 into. Now this asset was purchased on 1st April 2014 and year ends on 31st December. So asset was used only for 9 months. 9 divided by 12. So that comes to 38,250. So 5,10,000 minus 38,250 is 4,71,750. So this is written down value as on 31st December 2014, or we can say written down value as on 1st Jan 2015. Then less depreciation for 2015. Now depreciation for 2015 will be 10% of written down value, that is 4,71,750. So that comes to 47,175. So 4,71,750 minus 47,175, we get 4,24,575. This is written down value as on 31st December 2015, or we can say as on 1st Jan 2016. Less depreciation for 2016. Now how much is the depreciation for 2016? It is 10% of 4,24,575. That comes to 42,457.5. So 4,24,575 minus 42,457.5, that comes to 3,80,217.5. 0.5. So this is WDV as on 31st December 2016. So this is how we solve an example as per reducing balance method and calculate the depreciation. Sum of years digits method. Now the sum of years digits method is one of the variation to the reducing balance method. Now in sum of years digits method, what is done is we take cost minus residual value, that is the depreciable amount value. We divide it by sum of digits of number of years of useful life. Say if the useful life of the asset is 10 years, then we divide this by 10 plus 9 plus 8 plus 7 and so on plus 1. Okay, this cost and residual value. Then whatever amount we get, we multiply it by years remaining including current year. So for first year we will multiply it by 10, for second year we will multiply it by 9, for third year we multiply it by 8 and so on. So if we see Even in this case, the amount of depreciation will go on reducing as and when the years of the asset, useful years of the asset pass by. So here also we assume that the utility of the asset will get reduced as and when we start using the asset, or asset starts becoming old, and there will be higher repairs and maintenance in the subsequent year. That is what we assume in the sum of years digits method also. So this is similar to your residual balance method. This is one more variation to that method, and let's see one example on this sum of years digits method. A firm purchased an asset for rupees 4,50,000 on 1st Jan 2014. Installation charges rupees 60,000. The estimated useful life of the asset is 5 years and the salvage value at the end is 10,000 as per sum of years digits method. Financial year ends on 31st December every year. Calculate depreciation and return down value for year 2014, 15 and 16. So let us first calculate what is the depreciable amount. So depreciable amount is your cost, that is 4,50,000. This is working note 1. Then plus your installation charges, that is 60,000. So total cost is 5,10,000 less salvage value 10,000. So 5 lakh is the amount. Now this 5 lakh is a depreciable amount. This 5 lakh needs to be allocated over the period of 5 years. Okay. And this 5 lakh, what will be the amount of depreciation will be 5 lakh divided by your sum of the year, that is 5 plus 4 plus 3 plus 2 plus 1 into number of years of useful life including the current year. Now let's solve this. Working note number 2. Cost of asset on 1st Jan 2014, that is 5,10,000 less depreciation for 2014. Now depreciation for 2014 will be, what is the depreciable amount? 5 lakh divided by 5 plus 4 plus 3 plus 2 plus 1 into how many years are remaining? 5 years including the current year. So that comes to 1,67,000. So 5 lakh minus 1 lakh, 66,667 will give you 3,43,333. This is a WDV as on 31st December 2014. This is WDV as on 31st December 2014. Then less depreciation for 2015 will be 5 lakh divided by 5 plus 4 plus 3 plus 2 plus 1, that comes to 15 into number of years including previous year is 4. Number of years including current year, that comes to 4. So this amount is 1,33,333. So this is 2,10,000. This is WDV as on 31st December 2015 less depreciation for 2016. So that depreciation for 2016 will be 5 lakh divided by 15 into 3. That comes to 1 lakh. So 1,10,000 is WDV as on 31st Jan 2016. So this is how the depreciation is calculated as per sum of years digit method. Now say suppose the asset, now here we assume that the asset is purchased on 1st Jan 2014. Instead of that, the asset is say purchased somewhere in between the year or in the middle of the year. Then what we do is whenever we multiply this by 5, that is number of remaining years including the current year. What we do is we take the proportionate, instead of this complete year, what we do is we take the proportionate number here. For example, if the asset is purchased somewhere in between, then we find out what is the proportion. No. So this is how we calculate the depreciation as per sum of years digit method. Now, machine hour method or units of production method or depletion method. So, in all these methods, the depreciation is charged as per the utilization of the asset. Utilization of the asset. So, in case of machine hours method, what is done is the anticipated total machine hours for which the machine will be useful is calculated, and then it is divided. Then this will be your total depreciation amount will be divided by this anticipated total machine hours, and then it will be multiplied with the actual machine hours which were used for that particular year to calculate the depreciation amount. Then in the case of units of production method also, the total anticipated units of production will be calculated. That is how much units the machinery will be able to produce during its lifetime will be calculated. Then your depreciable amount will be divided by this anticipated total units of production, and then the units produced for the particular year will be multiplied with that number to get the depreciation amount for that particular year. Then depletion method. Now this depletion method of depreciation, it is mostly used in the quarry or ores wherein there are the which is an asset. So what happens is usually in the mines wherein, say for example, this is a mine. So in mine it is anticipated that there will be so and so units which will be extracted. So total available units. Now this total cost of this asset will be divided by available units, anticipated available units, and then whatever is extracted every year will be multiplied by this to arrive at a depletion of this asset. Now in case of gold mines and wherein there is an extraction of an crude oil, that fixed asset we cannot depreciate it. So what we call it is as depletion of that particular fixed asset. So as and when we extract, the amount of the crude oil or amount of the gold will go on decreasing, and then the accordingly that is charged against the income, and that is known as the depletion. It cannot be called as the depreciation. So this depletion method can be used only in the case of gold mines or other mines wherein we extract the crude oils or such products. So this is about the depletion method. So in all three methods, one common factor is the depreciation is charged on the basis of utilization. Now we will see one example for units of production method. A firm purchased an asset for rupees 4,50,000 on 1st April 2014. Installation charges rupees 60,000. The estimated useful life is 5 years and the salvage value at the end of 5 years is 10,000. Financial year ends on 31st December every year. Calculate depreciation as per units of production method and return down value for year 2014, 15 and 16. The machine is expected to produce 2,50,000 units in lifetime. Details of units produced in 2014, 15 and 16 is given. 2014, 20,000 units are produced. 2015, 50,000 units are produced. 2016, 60,000 units are produced. So we are given what is the total cost, then we are given what is the anticipated production of the units that the machine is expected to produce in its lifetime, and then we are given what are the details of units produced in each year, and accordingly we need to calculate what is the depreciation. So first let us calculate what is the depreciable amount. The depreciable amount will be your cost, that is 4,50,000 is the purchase price, plus installation, that is 60,000. So total cost is 5,10,000 minus residual value, that is 10,000. So the depreciable amount is 5 lakh. This 5 lakh. Now this depreciable amount of 5 lakh we need to divide it by total units that is expected to produce during its lifetime, that is 2,50,000. So 2,50,000. So here we get per unit cost, that is rupees 2. Now this needs to be multiplied with actual units that are produced, that is 20,000, 50,000 and 60,000 to arrive at the amount of depreciation for that respective years. Now let's calculate it. Working note 2. Now total cost. Cost is 5,10,000 minus depreciation for 2014. So depreciation for 2014 will be your 5 lakh divided by 2,50,000 into number of units that are produced in 2014. Let's see how much it is. So number of units produced in 2014 is 20,000. So we have to multiply it by 20,000. 20,000. So that comes to 40,000. WDV as on 31st December 2014 is 4,70,000. So for convenience, I have written what are the units produced in 2015 and 16 here. Okay. Now, less depreciation for 2015. Now again, 5 lakh divided by 2,50,000 into what is the units produced in 2015? It is 50,000. That comes to 1 lakh. So 3,70,000 is WDV as on 31st December 2015. Next, units produced in 2016 is 60,000. So depreciation for 2016 is 5 lakh divided by 2,50,000 into 60,000. So that comes to 1,20,000. So 3,70,000 minus 1,20,000. So that is 2,50,000. So that is WDV as on 31st December 2016. $2,50,000 WDV as on 31st December 2016. So this was about how we calculated depreciation as per units of production method. So in case of machine hours method, the total anticipated machine hours will be given for the total anticipated machine hours for the life of the assets will be given, and then in every year how many machine hours are used will be given, and in similar manner we can calculate depreciation using machine hours method also. And for the depletion method, the total amount of quantity available, anticipated quantity available in that particular mine will be given, and the total amount extracted every year will be given. So accordingly, using this similar logic, we can calculate what is the depletion for that particular mine as per this method. So this was about the machine hours method, units of production method, and depletion method. Now let's summarize. We have seen different types of methods of how to calculate depreciation: straight line method, then reducing balance method, sum of years digits method, machine hours method, and units of production method. So as per your nature of the business, and the condition in which the asset is used, we need to carefully decide on what is the method of the depreciation that we will be following for the particular entity. So this method of depreciation will differ depending on your nature of the business, nature of the asset, and the use of the asset. Now, for example, say in case of the industry wherein you may have a double shift or triple shift, the depreciation amount that can be charged to will that the depreciation amount will be double as compared to a single shift industry, since the machine is used more in case of double shift, triple shift. So the machine will be depreciated faster, and accordingly your useful life will change, and the depreciated amount will be more as compared to a single shift industry. So according to the nature of the business, the nature of how the machine is put to use, we can decide on what method needs to be followed. Now currently, as per income tax rules, this reducing balance method or diminishing balance, also known as diminishing balance method, is recognized as per your income tax rule. Now there are some exceptions. Say for example, there is an exception wherein an asset in the undertaking which is engaged in the generation and distribution of power, we can use other method. So other than that, for all the entities as per Income Tax Act, it is necessary to calculate the depreciation as per reducing balance method. That is, as per income tax rules, it needs to be calculated as per reducing balance method. Now this is only for the income tax rules. So as an entity, we can choose some other different method. Anyway, for the purpose of calculating profit as per income tax, we calculate depreciation separately. So it is not necessary that we use reducing balance method for our accounting books also. We can use different methods which is suitable to that particular industry for accounting purposes. Whereas for calculating income tax and profit as per income tax, we have to use reducing balance method as per current income tax rules. So this was about all the methods of how to calculate depreciation.